Hi again, I'm Brian Graham, Treasury Manager at First Calgary Financial. This is your economic update. A well-known Swiss-based financial watchdog recently sounded some alarm bells when it proclaimed that the world economy is just as vulnerable to a financial crisis today as it was in 2007, with the added danger of far higher debt ratios among the emerging market economies. The Bank for International Settlements warned in its 2014 annual report, released on June 29th, that financial markets have become convinced that monetary conditions will continue to remain easy for a very long time, although central banks are not in a position to give such an assurance. The BIS has gone as far as to urge central banks globally to begin tightening interest rate policies now, while economies are growing, rather than wait for another recession, when it may be too late to be effective. Who is the Bank of International Settlements? The BIS is one of the most senior and respected of the world's financial institutions and was created in Basel, Switzerland in 1930 to specifically clean up the mess left by German reparation payments after the First World War. It has since evolved into an international organization of central banks whose mission is to foster international monetary and financial cooperation and basically serve as the bank for the world's central banks. As an organization of central banks, the BIS seeks to make monetary policy more predictable and transparent among its 58 member central banks by regulating capital adequacy and making reserve requirements transparent. The BIS originally backed quantitative easing as an emergency procedure in early 2009 to avert a deflationary spiral, but has long since called for a return to sound monetary policies and even rate increases among its member banks. Their biggest fear is that the central banks may find themselves behind the curve, exiting their easy money policies too late or too slowly. The subtext of the BIS's annual report is that because many central banks have reduced interest rates essentially to zero, including the US and Japan, they are currently without the monetary weapons necessary to boost their economies should another economic crisis hit. The BIS also warned in its annual report that equity markets have become euphoric, as evidenced by a drop in stock market volatility to historically low levels. Puzzling signs include European equities that have risen 15% in a year, despite zero growth and a 3% fall in expected earnings, and a US stock market that has gone more than 2 years without a significant correction. Overall, the BIS finds it hard to avoid the sense that a disconnect has occurred between financial markets buoyancy and underlying global economic developments. The BIS blames prolonged monetary stimulus in the US, Europe, and Japan for leakage of liquidity contaminating the rest of the world, and, in particular, the emerging economies. Countries such as China, Brazil, and Turkey have succumbed to private credit booms of their own and are no longer able to act as a firebreak for the world economy, as they did after the Lehman Brothers crash in 2007, and may now, in fact, be at risk themselves. The ramifications would be even more serious if China were to falter, and BIS officials privately doubt that China's economy can actually avoid a hard landing, fearing that the extreme credit growth over the last 5 years has to lead to an eventual financial reckoning. Speaking after the release of the report, the current head of the BIS declined to be drawn into a debate on how or when the financial markets bubble may burst, but chose to quote the famous British economist John Maynard Keynes, who stated that the market can stay irrational longer than you can stay solvent.